Hey everyone out there. Let me just adjust my levels here real quick. Alright, there we go. Shouldn't be redlining anymore. Hopefully this is loud enough for everyone. So, interesting day so far. You know, it's been a pretty volatile period of time. We've got low liquidity. We've got a lot more options-driven participation in the market. And that's definitely driving more erratic price discovery, if you can even call it that. You've got the contract roll coming up next week, along with options expiration, the Fed, CPI, retail sales, and if that's not enough, you've got expiration the week that follows. Now, one thing you may not be aware of is when volatility products are expiring after options, it can make it a little more tricky to hedge. It can add a little additional volatility. And we could reasonably say this is a pretty under-hedged market. We can still see that the discount between implied and realized volatility is large, about 5.5 points when you add in a little premium for dealers. And that means that combining that with low skew, that we're in a market that's not well hedged. This is a market that there is some outsized left tail risk. Doesn't mean it has to come to fruition, but what it does mean is with a gentle push, you can get a much bigger reaction, particularly to the downside. And because there's over $1 trillion of index and ETF options volume every day, that push is more likely to come from that part of the market, from options, rather than, say, buying of shares or futures. But we do see something else that's pretty interesting. I posted this yesterday in the big picture room. And that is that we have a pretty sizable short position in ES contracts. Now, again, this doesn't portend to any sort of immediacy in a short covering, but it does add the potential for things like that to happen with greater effect when there are positive outcomes. Like, let's say we go into Tuesday, which is, again, the CPI is happening on the 13th again. How many times this year has lucky CPI happened on the 13th? More than I think is common. At any rate, you have lucky CPI happening on the 13th again. It isn't a Friday, it's a Tuesday, but it's still interesting. And what I want to kind of look at from that perspective is positioning going into it, right? So you have underhedged market dynamics in SPX options, but you do have aggressive shorting in futures. It doesn't balance out between the two, but what it does do is it does kind of add some dynamism to price discovery. So if we get a lighter than expected CPI, we could still have another face ripper, because once you have sequential decelerating inflationary data, you can start to make the argument that, the Fed's going to like what they see. That doesn't mean they're going to change their policy. It doesn't mean that anything in the immediate future is going to be different, but it does mean that the market is going to start pricing what it thinks might happen the next 3, 6, 9, 12 months out. And so those dynamics are going to come into play with an aggressively short futures contract. And it's not just the S&P 500. It is the 10-year note futures, the 30-year note futures. There's a lot of concentrated short positioning based on the latest commitment of traders' reports. In fact, in the 10-year, I think it's close to 1 million contracts on the 10-year note, which is substantive to see that much concentrated short positioning on one of the most key interest rate setting contracts in the world. I mean, there's about $100 trillion of debt in the world that's sensitive to U.S. rates. Most of it is sensitive to the 10-year rate as a benchmark for it. So there's just major implications. And, of course, people are shorting it for a reason. You have U.S. debt issuance increasing. The Fed is stepping back as being a buyer as they reduce the replenishment of their balance sheet. That is to say, they're letting their balance sheet roll off, but they're controlling the rate of the roll off. So they still do replenish some of these maturities as they're rolling off. Particularly in the bills, you'll see them stepping into auctions regularly because they're shorter maturity, so they have to. But you'll see them in the notes and the bond auctions as well. This doesn't mean that QE is happening again. It's not a conspiracy theory. The Fed has set caps as to how much they're going to roll off on a monthly basis. It's $60 billion with B on the Treasury side of their balance sheet, of which there's a significant amount of exposure. It's most of their balance sheet. And they don't have to do much to roll those off, by the way. They don't have to sell a single treasury. The vast majority of their treasury holdings are due to mature in the next several years. So their idea with QT on the treasury side is, okay, we're just going to stop being a buyer of large size. So when speculators in the treasury market are looking at that dynamic, they're looking at the government issuing more debt, Japan and China stepping back, and they're saying, the supply and demand situation looks imbalanced. There's some opportunity to exploit this. Then on the technical side, every bond chart until recently has looked like death. Pull up a chart of the price of the 10-year note or the 30-year note or even the 2 or 5. All of them look bad. And to be clear, the 2, 5, 10 are notes. The 30, I misspoke, that's a bond. So is the 20, which was only brought back not too long ago, I think less than 2 decades ago. But at any rate, you've got a lot of this paper that looks terrible on a chart, but for the reasons of concentrated short positioning, there's some potential for these things to catch a bid if you have better than expected inflationary data. So it's just a risk factor that we want to watch for. We've seen this on various inflation data days. It's happened on particularly CPI. That's been the most volatile economic data set that this market has dealt with. Particularly in 2022, we've set some CPI records in terms of the intraday volatility, particularly October 13th, where shorts got so aggressive that when the market went the other way, they were panic piling in to cover. And we saw kind of similar with the Brookings Institute meeting with Powell. Now, why is this important? Because this sort of thing can continue to happen as long as positioning is at an extreme. And you could argue it's not the worst it's been. We've seen the S&P futures far more highly shorted than this. But 600,000 plus contracts is enough to at least watch as a right tail risk. Because if you're short this market and you get a pop like that, it's going to have an impact on the broader market as well, particularly pre-market. So we'll be keeping an eye on that. We have seen some interesting flows in the options market as well. Yesterday, we saw the largest total, and this is between index and equity options, put-call ratio rising to levels we haven't seen since the COVID crash. Now, what's interesting about that is we're not seeing volatility really rise commensurate. So you would think with something like that, you'd see, skew rise, you'd see volatility rise, you'd see some meaningful position changes. But we haven't seen as much of that. I think part of it has to do with the fact that there's so much playing around in these, 1, 2, 3 DTEs and even 0 DTEs. It was something that was much more popular in the single shares and some of the ETFs last year. It's become a phenomenon in SPX as well. And that may be, kind of changing how we look at some of these measures. I know that we have a new volatility measure now, 9-day vol. I believe CME put this out, 9-day volatility, which is interesting. I was tracking that for a little bit. It doesn't seem to move too terribly different than 30-day volatility, which is what the standard VIX is. Their so-called new methodology is sampling forward 30 days, right? It's looking at the next month. Well, that's cool. 9-day maybe gets us a little more insight about what we're seeing in the much near dated options market, so maybe we should be paying a little bit of attention to that as well. I have it on my radar. It's not, though, as easy to access on some services. You're not going to find it on every charting service. The other thing that I think is important to pay attention to is realized volatility. I've been speaking a lot on the Discord about, and on the website, about the discount that we sometimes see. When realized volatility is higher than implied, what you're basically seeing is a market that is assuming that the future is more certain than the past. And that's a hard thing to do. Because essentially, if the past isn't some sort of like mega crash, which 2022 has not been, then how can we say the future is more certain? We're still in a bear market, right? It doesn't seem like that's changed. We're going to have violent face-ripping counter-trend rallies like we've had since, mid-October until recently. But at the end of the day, we have those violent face-ripping counter-trend rallies because we're in a highly volatile bear market. So that would make it at least more likely in my mind that future uncertainty should be as high, if not higher, than past volatility. Because what the volatility index measures, really no matter which one you look at, it's not fear. It's uncertainty about future pricing over a specific period of time. Again, with the VIX, the next 30 days. Well, if we're looking at the past 30 days volatility, and it's meaningfully higher than what we're implying the next 30 days are going to look like, that suggests a market that's not accounting for risk appropriately. And that's what we're looking at when we talk about the discount between implied and realized volatility. And why that matters is because there's more risk potentially than is being accounted for. Now, on the one hand, that can present opportunity. Sometimes that means that risk is mispriced, and I wrote an article about that. Maybe that was a good time to consider buying some hedges, because at the time the discount was close to 8 points, and the last time we sunk from higher than that into below 7 points, the next 5-day return was 64% likely to be down, as high as 15%, as we saw during the COVID crash and the great financial crisis, but more normally 3 to 5%, somewhere in that range. Now, why is that important? Because a lot of the time with trading, we're just trying to assign probabilities to outcomes and develop systems based on realizing those probabilities should they come to fruition. And with this particular scenario, we've seen this play out over 30 years of data, that the risk to the downside was quite a bit higher when there was a pretty big discount between implied and realized volatility on the S&P 500 index, looking at realized over a 1 month period, right? So that's going to be 21 trading days, and implied over the next 30 days. So it's an easy model. You could put it together. You can do back testing on it. You can tweak it. I'm sure there's variations that can make it better. But the key for me on this one was looking at it not when it was below a certain number, but when it had crossed below. Because what you're seeing in that is that it's moving lower, that the market is becoming more poorly hedged below what is an extreme level, that discount. So for me, that becomes more intriguing, because you can take that event, not the fact that it was at -7, but that it had crossed below -7 from a higher number, and you can look at what happened when those sorts of dynamics were in play over the last 3 decades, over 7,000 trading days. And that's a pretty good sample size, and it's through a lot of different market environments. And it's something that's more true, I would say, in bear cycles, but still something to be cautious of in bull cycles, particularly older ones. So just a little bit of kind of looking at back testing and why that's important, right? I know we all like to trade in various ways, looking at charts, looking at volume profile, looking at indicators, all sorts of different ways. There's amazing ways to put these dynamics on your side, particularly when there's a coalescence of different variables that point to an outcome. And this is one that you can add to your toolkit that looks at things completely differently. Right? Instead of looking at key levels, we're looking at relationships between volatility and price discovery. And we're trying to determine, in this case, 5-day forward returns, because that was where I saw the greatest probability of shorts manifesting, or hedges paying off. So we can see this week, this article was put out, I believe, on Saturday. We can see this week this has played out, in the sense that we've moved now towards the lower end of this trend channel. You can see it in the motive wave chart on the lower right of your screen. We've moved now to the lower end of that trend channel. We've tested it twice, once overnight and once during the prior day session. We've bounced there, and now we're just kind of hovering around that yearly point of control, that congestion zone where so much volume is transacted, around 39.6750. So I'm looking at about 255 trading days of data, or about a full year's worth of trading days, to sample volume and draw that volume profile based on extended and regular trading hours. So for the yearly chart, I'm looking at everything, and I think that's important. And you can see how much interaction there's been with this level, particularly recently. Look at mid to late November through December. This has been a very key level for the market to transact. It likes to transact there. And when it gets above it, you see some momentum. When it gets below it, you see some momentum. So it's kind of like a key pivot level on your yearly chart. The more we flirt with it, challenging it from below, the more likely is we pierce through it. On the other side, though, we do have a pretty meaningful risk that we should be paying attention to. First, we're seeing some support on that Kijun-sen line. That's that orange checked line there. That is an area from the Ichimoku cloud that's sort of the lagging indicator that is important to watch. because sometimes it can indicate when you fall below it that there is a trend change. And interestingly enough, that bottom trend line, similar story there. We've touched it again twice over the last, 2 trading sessions, essentially. And if it gets pierced from, from basically a crossing from above to below, again, I think that's 3 strikes, you're out. So I'd say we're at a pretty key area of price discovery here. It doesn't mean anything has to happen this week. Fireworks could very well be saved for next week when we've got a whole boatload of pivotal events, volatility catalysts, structural changes in the market, things like the contract roll-off, but also the options expiration, which is going to be a pretty big deal. I think these triple witching options expirations have been huge drivers of volatility. But they also change a lot of the dynamics in the sense that it gets a little harder to trade in those environments. And Horst spoke about this a bit in yesterday's market prep, yesterday's midweek update. But in essence, when you get into these periods of options expiration, then you throw in contract roll, the Fed, CPI, all this data, you pretty much can throw out a lot of the systems that we might trade on intraday, right? The intraday stuff becomes way more noisy. But the longer term charts are still important. So we're going to still want to watch these levels and see how we close out, particularly on a weekly basis. I think we're going to see some pretty big fireworks in the week ahead. I could be wrong, but I think we will resolve this. Whether we are going to close above that 39.6750 yearly point of control and continue to move in this uptrend channel into the end of the year and something resembling a Santa Claus rally because we do have seasonality on our side, or if we're going to cross below the bottom of that trend line and start to really explore these lower levels, of which there's not a whole lot of support unless we retrace back to basically before that November spike that we see. So I would be just a little bit mindful that there's pretty significant risk in either direction. We can't have a particularly strong bias until we figure out which way the market wants to move. And when it tells us what it wants to do, there will be opportunities that come from that. When we get a meaningful move above that pivot level, if that's the case, if that's what happens, then an extension would be the logical conclusion. Doesn't mean it has to happen, but probabilities are on the side of that. So that's how I would play that. I would be of a long bias for short-term trades, particularly intraday. However, if we move below that bottom trend line on a closing basis, I'm going to say, you know what, I think this bear market rally is over. And it's probably time to raise cash on any remaining longs and start to maybe look at more aggressive shorting or hedging any remaining longs. So that's kind of where I stand. It doesn't mean it's investment advice, of course. This is just kind of me trying to share how I'm looking at this market in case it helps you to learn more about trading, investing, and just managing risk in a rapidly evolving environment. I still lean more bearish on the intermediate term. Okay, so short term, we're seeing right now anything can happen. Long term is a totally different story, and even intermediate term. I think intermediate term, we do have higher probabilities of retesting the October lows and probably taking them out in the first quarter of next year. And the reason I say that is I don't think that the market is accurately pricing in both the risks of a more meaningful recession and a Fed that continues to run off their balance sheet and keep rates as high as they can for as long as they can. Something's going to break eventually. That's the other thing. The Fed isn't going to necessarily turn around because inflation magically reaches their 2% PCE year-over-year level. It's much more likely that inflation is somewhat subdued, but we see that something systematically important breaks, and the Fed then says, you know what? We're going to have to put our crusade against inflation on pause because we need to make sure that the financial plumbing doesn't break down and we don't have a greater crisis. So I think that's kind of where we are, and we haven't seen anything to say that's happening in the imminent future. I mean, I know there's been a lot of discussion about Credit Suisse or FTX contagion risk or some of the things that are happening in the Chinese real estate market or even the implosion of sovereign debt, but we haven't yet seen those dominoes really begin to fall. We've just seen warning signs. So there's some surprising resilience in the financial system. It's certainly not the same dynamics we saw going into the COVID crash, where there was an actual catalyst that caused a lot of economic disruption, nor is it similar to the dynamics we had before the great financial crisis, because we don't have the same level of interconnected systemic risk, at least not that I'm seeing. I could be missing it. A lot of people didn't see the great financial crisis coming, but let's look at one analog that is kind of similar, and that is the dot-com era. There's some similarity there because there was a pretty significant asset bubble, particularly in stocks, that became an enormous catalyst for a drag on the economy and financial markets really becoming more risky. It wasn't systemic risk like the great financial crisis, but it was certainly causing pressure. And it had everything to do with the Fed popping the bubble, the same bubble that they had created. Easy policy for over a decade helped to foment the dot-com bubble. And similarly, really easy policy helped to foment the real estate bubble. But this time around, we had the easiest policy in human history from almost every central bank in the world, and it helped to foment a very large interconnected multi-asset bubble. That being said, we don't necessarily have the same kind of financial leverage in a lot of the financial system, excluding China, that we saw going into the great financial crisis. So it's a lot different in the sense that the system is more resilient, but eventually it will buckle, eventually it will break. And when it does, I think that's when we'll start to see the Fed turn around, but that's also probably not too distant from the time we'll see a durable market bottom in place. Because if you think about it, that may be the catalyst for it. For the deleveraging that gets a little disorderly, you see that sort of what everyone's been looking for, a capitulation moment, de-risking, raising of cash, deleveraging margined portfolios, things like that. And then maybe the smoke starting to clear as the central bank comes in and takes some emergency measures to let cooler heads prevail. We don't have anything resembling that moment imminently, but at the same time, in fairness, they don't necessarily give us a whole lot of warning in advance. So I think it's important to just be mindful that there's still tremendous risks. More of those risks point to downside. Certainly, anything can happen, anything can change. But I do think it's important for us as investors and longer-term traders to just be aware of how tail risks to the left are pretty morbidly obese, right? So I think, and I could be wrong, that there's going to be better prices for long-term opportunities. I'm naturally an optimist, even though I've spoken bearishly on Twitter and on here on TraderAid for quite a while. The reason I've been bearish is because the macro, fundamental, and technical picture have all lined up as quite bearish. And so until those things change, my intermediate term bias isn't going to change. Short term is a totally different animal, because anything can happen on a day-to-day basis. It's much more driven by liquidity, by positioning changes, by those sorts of positioning-related rotations, by exhaustion from one side or the other, and then reversals. This is something that we don't have to apply a broader macro or fundamental framework to. We're looking much more at where's liquidity prefer to transact, and where does it want to transact, like what our charts show on the live stream. That's kind of what I'm trying to focus on with these multiple time frame volume profiles to show where volume has wanted to transact in the past versus Bookmap, which shows you where volume wants to transact in the present, right? And so we have some tools here to focus on one of the most important parts of the market, in my opinion, which is the transactional activity. From an intraday basis, that really matters a whole lot. Price discovery is often governed by those factors. Now, less so during a period of like this with options expiration, contract rolls, and all kinds of event volatility catalysts. So, that's the caveat, but that's the reason we're kind of focused on those elements for the intraday. On the very long term, once we go out, say, 5-10 years, I'm still quite bullish. I think we will have better forward returns over those types of time periods, but the question is from what levels? And so one of the jobs we have here at TraderAid is trying to research these things. It's why I track different intermarket dynamics. It's why I track a lot of the macro and technical data that I do. And it's also why we're looking more and more at fundamentals. We're looking more and more at just the really bigger picture view, drilling down from there into the microscopic view and trying to put it all together. Because we do believe there will be some generational opportunities that could come out of this bear market when the dust starts to settle. But at the same time, there's nothing to say that that bear market is over yet. We have a series of promising counter-trend rallies that are predicated on the notion of a imminent Fed pivot, which seems to be about as likely as a unicorn manifesting in our portfolio, at least in the here and now. There's just nothing that even the Fed themselves say, yeah, we'll slow down a little bit, but we're not even close to done. And, Powell last at the Brookings Institute meeting said what the pace of our easing is much less important than how high we go and how long we stay there. And of note, no one's talking about quantitative tightening, and I have to wonder why that is. I've joked about it a little bit on Twitter, but my opinion is that it's still a very experimental apparatus for tightening. They've never, and no central bank has ever, normalized their policy after QE. Ever. It's never happened. Is it going to happen this time? I don't know. I don't think so. I think things will begin to break before something like that could happen. The balance sheet is over $8.5 trillion. A lot of that after COVID, but, the rest mostly after the Great Financial Crisis. Before the Great Financial Crisis, I want to say it was less than $500 billion. It was certainly materially lower than it is now by 95%. So how are they going to normalize something of that size when it's become such a systematically important part of the Treasury market, of the mortgage-backed security market? I don't think it'll be possible. I think we'll find that the other part of what happens to kind of get the Fed to turn around is that the U.S. government has a growing debt burden. And that debt burden was being sated by the Fed. Their appetite for bonds was helping the government borrow more money than they should have been able to, because the Fed was, in fact, monetizing the debt, counter to what Bernanke had said in front of Congress in testimony, where he said that that's not something we're doing, it's not something we're going to do. That's what QE has always been. It's been government debt monetization by another name. So why is that important? Because if we're not getting QE, then the government has to find other folks that are willing to take on the risk of its balance sheet over various tenors. It's also important because during the COVID artificially low rates period, the government wasn't aggressively refinancing their debt to longer dated maturities. They had every opportunity. And that would have alleviated some of the burden we're about to face. Because now we're facing several years ahead where there's a fair amount of treasuries that need to be refinanced. There's also a pretty healthy amount of debt issuance that's likely just from interest on borrowing alone, not to mention any new spending, like this giant government defense spending bill that's about to pass. Where's the money going to magically come from? Eventually, the Fed's going to have to come back and start monetizing the debt. And here's why it's key. Something that's not often discussed about quantitative easing is when the Federal Reserve holds treasuries on its balance sheet, every year at the end of the year, it calculates all the interest it earned from the U.S. Treasury and it sends it back to the Treasury. So think about that. Wouldn't it be nice if you had like a credit card or a line of credit with a bank or something like that, and you could just borrow all year long and, you pay it down when you can, but they just give you your interest back. Any of the interest that you paid to them, they're just like, here you go. Well, that's what the government had with QE. Does anyone realistically think they're going to want to give that up? The Fed has been the biggest buyer of U.S. Treasury debt at auctions for years on and off. And I don't know that we're in a position where anyone else is going to step up. China used to be a big buyer, but geopolitical tensions and an appreciating dollar have kind of tempered their appetite. They've been a net seller in 2022. Japan used to be a huge buyer of our debt, but currency hedging costs have deterred that appetite as well. Saudi Arabia used to be a meaningful buyer, but geopolitical tensions have not served us well in that department. So we're seeing a less significant appetite for our debt, both domestically and abroad. So where does that gap get filled as the government is not only issuing a lot of debt, but upsizing debt issuances 2 quarters in a row? In quarter 4, they upsized from $550 billion to $700 billion. So we have to again ask, where is that all supposed to come from? And I don't think there's a very clear answer if we omit the Fed from the picture. But if we do include the Fed, particularly with QE allowing the government to borrow a good chunk of debt interest-free, I think it makes the case that that's another reason we will see QE eventually come back. So the question we have to ask ourselves about QT is how long? And how low do they run off the balance sheet? Well, under current parameters, it's $60 billion a month of treasuries up to $30 billion a month of mortgage-backed securities. If we annualize that, that's $1.080 trillion per year. Up to. That's no small amount. So it will have a material impact. There's a positive correlation between the aggregate size of central bank balance sheets and the performance of risk assets, whether it's stocks, whether it's junk bonds, whether it's crypto nonsense. This stuff is all tied together because it's just basically a place to park your money where you hope it appreciates during a time that's friendlier to risk. And when rates are oppressively low, so you can't put your money in a money market account or a savings account or bonds because people weren't earning. Well, that dynamic has completely changed, right? We are in an environment where there is an alternative and where there is lower risk returns. Doesn't mean return-free or risk-free returns, right? But it certainly does mean that there's lower risk returns possible in fixed income than we've seen for probably over a decade. And that's interesting. I mean, look, if you can get paid by some of these major blue-chip companies 5, 6, 7% on not long-duration debt, 5, 6, 7, maybe 8 years, that's not a terrible situation. At least not in my opinion. It makes those things kind of attractive to me. Similarly, the U.S. government, 1 or 2 year maturities, close to 5% before, but now, over 4% on a lot of them, still kind of attractive. Do we think the U.S. government's going to default in a year or two? Probably not. So maybe there'll be some appetite for the shorter duration maturities because they're of sufficiently high rates to attract bidders, but the longer duration, not so much. There was a great opportunity to refinance a lot of this debt during a time where everyone wanted it, and it just wasn't seized by either administration, might I add. It's not a political party issue. It's just maybe a foresight issue by the Treasury. And maybe they thought they couldn't do it. Maybe there's other reasoning I'm missing out here. I don't have visibility into everything, but that's just what I'm coming away with based on, kind of what all I'm seeing here. So let's just take a quick look at the market. And then I'm going to hop off mic for a bit so we can prepare for Bruce from Bookmap to join us at 1. So if you don't know, Bruce from Bookmap will be joining us at 1 p.m. to talk more about Bookmap. He'll be on the stream in this room at that time, so don't miss it. We will be looking to record it as well, and we'll put a copy on the website later for everyone. So underneath the surface in markets, we've got the NASDAQ leading. Earlier the Russell was, but it gave a whole bunch of that away. Seems like when I mentioned earlier that the Russell was outperforming and we're all going to die, it heard and it almost died. So maybe the Russell's listening to us in its hustle day to day. We've got Bitcoin up about 1.17% too, kind of risk on across the board and long duration risk. You've got things like ARK that are being bid up over 2%. You've got total garbage fires like Coin that are up over 3%. Just a lot of this sort of more speculative stuff has a healthy bid today. Seems that for whatever reason people want it, except for Tesla, which is down almost 2%. For some reason, Musk's company is starting to see greater pressure. In fact, the chart on Tesla looks downright dangerous if you pull it up on a daily or a weekly. We've got a mixed picture in the overall commodities market. We have strength in soybean meal, weakness in oats, and lean hogs. We have noteworthy strength in the metals in silver and palladium. Gold pretty muted in comparison. We've got cocoa, orange juice, and sugar having a nice rally. Sugar starting to show some impressive technical qualities. That might be one, if you're comfortable looking at agriculture and commodities, to just put on your radar. There are some ETFs like Cane, C-A-N-E, that look pretty interesting. Natural gas is having a day. It's up over 5.5% despite data showing a lower than expected draw during a warmer than expected winter. But perhaps people are starting to look ahead and saying, you know what, the Farmer's Almanac still expects a pretty cold winter. Perhaps that is going to still come to fruition. So that could be part of it. We'll definitely have to keep an eye on natural gas because it does look like it's trying to put in a bit of a bottom here. And if it does, maybe we'll get another chance to play it. In the currencies market, the dollar's down by just under 1/3%, and we're seeing some strength now coming into the euro. It was lagging earlier. Now it's up about 0.4%. The loony's up about 0.5%, and the Aussie's up about 0.53%. So we do have some strength in some of these more commodity-oriented currencies with the Canadian dollar and the Aussie, but also with the safe haven Swiss franc and the euro. The yen is completely left out, down 0.14%. This might have something to do with the Bank of Japan saying we will continue with QE eternity for as long as eternity. That's probably not good for their currency or their bonds, especially their currency, but they're going to do what they're going to do, and they probably don't have much of a choice with a 300% debt to GDP ratio. Really quite incredible. 30-year bond, it's pretty weak. It's down 0.52%. It is off its lows by a bit, so that's helping the markets feel just a little bit better. And we're seeing that there's just a pretty overall risk-on day. So the types of sectors that are being bid up and industries, we've got semis leading, tech following, metals and mining. These are cyclical sectors, or these are risk-on growth areas of the market. These are things that people allocate into when they feel confident. Also underneath the surface in factors, you have about 0.91% preference for high beta over low volatility large caps today, which is, again, a risk-on sign. You see similar in the debt markets where junk is outperforming investment grade and U.S. sovereign. So, people just are willing to take on more risk today. You also see it in the factor preference. Russell 2000 growth, the strongest factor outside of large cap, high beta. So that's another risk-on sign. And on the other side of it, you've got Russell 1000 value, the large cap value, not getting much of a bid at all, only up 0.64%. So underneath the surface, people are bullish. The NYSE breadth is 21-9. So that's a lot more advancers than decliners. That, usually when you see that more than 2-1, it's pretty bullish underneath the surface. So I would say overall today is a constructive day, but within the context of a broader, fragile environment. Low volume, mispriced volatility, underhedged. So there are meaningful left tail risks with any kind of event volatility catalyst, and we've got next week coming up, which people will probably start to think a little bit more about tomorrow afternoon. For now, tomorrow's probably seen by many as Lotto Friday. You might see more short duration participation, these 0 DTE options plays that tend to get squeezed up if we have a constructive day in equities. So look for that. If the NASDAQ and the S&P are well bid, there might be some delta squeezes happening. Today, we've got just a little bit of delta squeezy action happening in SMMT or Summit Therapeutics. There's a lot of buyers on these at the 4 strike and just above. It's already up 30%, so I'm not touching it, but I am observing it, that there's just a little bit of that activity happening there. And we just see unusual volume in a couple of different stocks. Pfizer has got 790,000 shares that changed hands in the last 3 minutes. The TQQ's pretty similar, 668,000 units in the last 3 minutes. And Google, which is down just about 0.75%, 630,000 shares changing hands in the last 3 minutes. So a lot of really active trading in some of these stocks. Tesla also making the list at just under 500,000 shares in the last 3 minutes. So, there's no shortage of volume for some of the more popular commons, but for some of the others, they are showing wider spreads. They are a little bit less liquid. So that's something to be aware of. If you're playing the small caps and the mid caps, if anything goes against you, it can get kind of nasty in a heartbeat because the bid just seems to disappear, or at least the spread seems to widen such that slippage becomes a real issue. So I hope this is helpful for everyone out there that's listening. I think that one of the things that we're going to keep paying attention to here are these dynamics that are playing out towards the end of the year. Next week, we're also going to have analysis of the Fed. So keep an eye on that. After Jay Powell finishes speaking, we're going to give our thoughts about what we think it means for the markets and the economy. And again, in an hour, Bruce Pringle will be joining us from Bookmap to talk about the system that he helped to develop. I think Bookmap is amazing. If you watch my stream on the video side, you can always tune in when I'm live to the left-hand side and see Bookmap. And just so you know, I am working on, no promises yet, making Bookmap available during all Globex trading hours. So that's something that's a work in progress. Need some patience as I'm figuring out all the details as how I'm going to do that and make sure it's stable and reliable. But it is something that I want to try to do for you all to, just add a little more value to what we're doing here. So, in closing, thank you all for being members of the Trader Aid community. We appreciate each and every one of you a great deal, and I will be catching up with you in just about an hour when Bruce Pringle and Horst join us to talk more about Bookmap.